Okay. There's a there's like a 20-second lag time between like when I say stuff and when it gets to you. Lag's heavy, but okay. Let's begin. Just type, I don't know, AT in the chat if it's all good, and then we'll begin. Yeah, try first. We get about like a few hundred viewers, but they all comment like when the stream is done. So I don't know. Okay, great. We will begin. Uh, this this lesson is going to be on technical analysis, which I've called some lines and stuff. And I think the most important thing to remember about technical analysis is the Dante quote, right? All you need is a bunch of horizontal lines and stuff. It's not like if you see someone with hundreds of different, of different types of indicators and stuff like that, they're not doing it right. They have no idea what they're doing, and I'll show you what I mean by that. So, what is TA exactly? What are you looking for in technical analysis? Some people think it's like patterns that repeat and whatever, but the truth is, people are going to behave the same way, right? In different markets and different time frames. The one thing that's a constant is how people behave and people's emotions and that kind of stuff, and that's really what you're looking for. That's what you're looking at when you see all those green candles and red candles. It's you're basically playing a game of chess with like 1,000 other different people. So we will look specifically at these points, these 6 points that I've listed out here: time frames, lines, indicators, chart patterns, and candle patterns. Just keep saying stuff in the chat so I know everything's going okay and that kind of thing. Now, on the right here, I've put up a screenshot of Peter Brandt, who is probably one of my idols in crypto. Well, not in crypto, but in trading generally. And the reason for that is Peter Brandt has been trading for like 40 years successfully. Hi. And you can see from his charts, you can always, in fact, you have to go follow Peter Brandt on Twitter immediately to understand what I'm talking about, and the way he trades. He calls it classical charting, and it's very, very simple, right? He doesn't need all kinds of people make this false equivalency when they see someone using 200 different types of indicators and stuff, and that's just not what you're doing. When you do that, you're gonna get too much noise and not enough confirmation, and in truth, TA itself is very probabilistic. You're not going to be right 100% of the time, so you're going to have to make losses. But if you use the risk management strategies that we talked about last class, then you should be all right. You can see he doesn't even have like volume bars at the bottom here. It's just lines and understanding like basic chart patterns that come along with it, right? So these two lines are obviously support and resistance, and this is a range, and he's it broke out of the range, which is a good thing. Same thing, right? This is a horizon wedge down here. Usually that's a bearish pattern, but if it breaks up, the target is quite simple. Is the range of the original horizon wedge. Yeah, on unfamiliar truth, he's probably one of the biggest plebs in the world, but he's still a successful pleb. Anyways, let's continue. So, talking about time frames, the only thing that's important to remember is volume kind of determines what time frame you can trade on. But as someone who's starting out in trading, you should probably stick to minimum of daily candles, right? A daily time frame, because basically in most of crypto, that's going to be like the time frame when, because how TA works is probabilistic, right? But the probabilities go up as the time frame goes up. As the time frame and the volume goes up, the whole thing goes up, right? So you have this this thing where if you're trading a really high cap with hundreds of millions of volume per day, then you can probably go down lower to I don't know, maybe 12 hours. But with most alts and things like that, you should probably stick to daily. And if you're doing like really low crap coins, you can probably come down to, you should probably go higher to like 3 days or even weekly. So yeah, time frames. And always remember to zoom out before you go in. So just start with the weekly, so you can see where the general trend is going. Then maybe you can come down to like a smaller time frame that suits the volume, so you can understand. And for this class, every time I talk about something, we're gonna look into it with a chart. We're gonna actually do some live charting, so you can understand what I mean. And it's not just like it's not just some ideal situations that I found with a screenshot somewhere, but you can actually see what I'm talking about in some live charting. So I wanted to use BTC USD because it's probably the most high volume thing you're gonna trade. I mean, there are other stuff, but this is probably the most high volume stuff that you're gonna trade anyway. So we should probably use this. So when you begin, weekly, right? You look at it, you see where it's going. It's going up, so okay. If you hold long enough, you'll probably be in profit. But if it's going down, that if you hold long enough, you're gonna be in a loss, right? That's just the general idea that you need to understand in the first in the beginning. So switching back to the PowerPoint, the next thing we're going to talk about is lines, right? It's probably the most usual thing you're going to see in people's TA is the lines they draw, what it means. In this situation, we're going to talk about horizontal lines and just channels, right, or diagonal lines. And usually when I chart, I put the I put the resistance line as being red and the support line as being blue. so people get the idea that, okay, I'm saying it's gonna bounce at support, and if it doesn't resist, it's gonna break that. And on this side, this is a typical diagonal channel. It's gonna go up and down, and to give you an idea of what that means in real life, let's look at a live chart of BTC USD. You can see if we switch to log scale right there, right here, log scale. No, that's fucked up. You can get a better idea of what a chart looks like. Sometimes if it doesn't look to it, and you can see from this that BTC traded at Bitstamp at one point for like $4. Look at that. In 2012 it traded all the way down to $2, right? And you can see the runs, the different bubbles it's had, right, from 13 to 167, then drop down to 66, and then run again to 1,000, then drop down again, and running again to 6,000. And you can see how a typical support and resistance would work. If you look right there, this is a weekly chart, by the way. If we can, let's switch to daily so it's easier. Yeah, let's switch back to weekly. This is getting too big now. So it's pretty simple to see where the support and resistance here was, right? Switch this to red for resistance. By the way, I like to draw the lines like this and use this, but you can also use like a straight up horizontal ray right here, and just do that. And you can see again where the support was, right? But a very important thing to remember with lines is that it's not a specific point, it's more of a range. So always be comfortable with just drawing a specific range as opposed to a line directly. Now, most people know that the recent support is usually the previous high. So I mean, this thing right here was crazy, but if you look at where this candle dipped into, the very last run, it was right on top of the previous high, right here, and you can see where the range was, which is exactly what we're talking about here, right? Then immediately after that, you see the channel, or the diagonal lines, like I call it, and the channel. There's a thing that I like to use here. It's called the parallel channel on TradingView. It kind of helps you see where a channel is, and if we switch to daily, you'd see how this works. Went here, came back down, went up again, came back down, but then it broke that channel, right? Came back and tested it right here, and then started a new channel. So if you start from that one and draw an even more stupid channel, I should probably let me remove this so it's kind of less annoying. Switch to daily so that it makes more sense. You can see where that channel was, right? Now, people sometimes like to use, you can see where it started right here with this dump to this red candle. And then that was the channel, right? Traded inside the channel until it reached here, broke out, tested the channel again, broke out again, tested the channel again, then continued. Now, some people like to use these pitchforks to to trace channels, because it kind of helps you. It kind of helps you. It helps you sort of do channels within channels, if that makes sense. But we'll just talk about just straight channels now. You can always by yourself put I don't know, smaller channels in between them if it helps you. But what the fuck is this? So like, look at that channel. Once again, if you look at inside that, let me switch this color so it makes sense to yellow. So if we zoom in into this, you can see where it traded that bottom and then broke out, retested it, and then went again. But channels within channels is totally fine and up to you. But then now we have a new channel, right? But this time it's looking a lot less like a channel and more like a rising wedge, which a typical chart pattern that you're gonna see. And with that, let's switch to the next thing. But let's talk about chart patterns. About patterns, it's not blowing your mind, Trifers. Come on, this is like basic stuff. So, about chart patterns, you should probably download this. I'm gonna put a link in the Slack. This is like my screensaver on my laptop, and I put it up there like 2 years ago, and it's been my screensaver since then until I got this new computer that won't freaking work. But this is important because this is all you're gonna need. Well, basically, really, all you're gonna need for patterns. I mean, you're gonna learn about other, like, some Japanese stuff later, and when you hear about, like, haramis and hikakes and that kind of stuff, that's like Japanese patterns, but that's more like for another class some time. But the point to remember is, if you see, so look at this for example. This is a rising triangle, but it's not the same thing as a rising wedge. The difference is that a rising channel has a horizontal resistance level, whereas a rising wedge has like a rising resistance level right at the top there. And this is a bearish pattern, right? But this is a bullish pattern, and this kind of like stuff is what you need to memorize. There's just no way to. I mean, it's not gonna be easy. I mean, I can't just tell you like a easy, way of remembering it all. But with time, if you chart more and more, it's just gonna become second nature to you, and you're gonna like memorize the whole thing. But it's important to just, if you want to print it out on a piece of paper and put it up on your wall, and when you wake up every morning, you pray to it or something. I don't know if it helps you remember it. If it helps you remember it, then good for you, right? So, speaking of rising wedges, this is a big ass rising wedge, right? and the reason why I call it a rising wedge is, because it because I mean, you can still call it a channel if you like, but in I think it's probably better. Looks like a rising wedge to me, and you can see the range again. You can see the range where it's gonna most likely bounce, and don't be afraid to draw loom lines. Some of them are gonna get supported. By the way, important thing to remember: one test like this is not a line. Okay, 2 is just coincidence. A line becomes a proper resistance or support line when it touches 3 times, right? So this goes 1, 2, 3, right, and then goes 4 and 5. It's a really serious line. Now it doesn't mean that it's not going to break one day. It might break, but it's probably most likely not going to break, right? And this kind of gives you an idea of where to buy something, where to sell something, or where to take some profit if you believe it's going to break upwards. Now, there's a website, Bukowski or something like that. Bukowski's site. Great, it's freezing now. Bukowski pattern site or something like that. Now, what it gives you is the most important thing you're going to find there is the probability. This one, I think it's called the pattern site, but it's owned by a guy called Bukowski, who's like a legend in the TA circles. And what it gives you is one of the most important things to find here is the probability of a pattern breaking up or down. Now there's an actual Excel spreadsheets with all these numbers. But the guy who owns it, I don't think he's gonna be happy if I gave it to you guys. So I mean, you kind of have to, you're gonna have to find it for yourself and download it. But you can see the chart patterns and this is all free, right? It doesn't. It's not. He's not gonna collect money from you because he's actually rich. But there's a probability. There's a probability number for all of these patterns, right? So something's 70%, likely to break up. It's 80%, 80% likely to, break down. That kind of stuff, right? So let's take a rising wedge for example. Calls it a rising video, whatever, man. And here it explains, it's bullish 75% of the time. Yeah, this is a rising window. It's not the same thing as a rising wedge, but the point is, this site is free and it gives you all these probabilities. 7% of the time it's bullish, or it's bearish. It's gonna break up or break down. How many percent of the time? And again, all this stuff is free. You can just, this is your new home now, right? Everything you do is going to be on this guy and what he says. So going back to, and by the way, just memorize this stuff, keep it in heart. Head and shoulders, rising wedge, falling wedge, the targets. It's that is the most basic stuff that you need to know. Now, going back to indicators. I really had a hard time picking what to talk about because I wasn't sure what to focus on because I didn't want to. Once again, it's about picking one or two that works for you and then just sticking to it, right? And this is what I use. This is what works for me. So I decided I was gonna talk about these two specifically, and that's the moving average and the volume bar, right? I've tried everything, man. I used Storch RSI, I used MACD. The only thing that I wanted to look more into but didn't was Ichimoku, and the reason why I didn't look more into it is because it's basically the same thing as just some moving averages and some fibs like put in together in one thing. So if you learn like the basics, you don't really need to. You can just put it together yourself. So talking about moving averages, let me show you something else that might actually be interesting. Shut up. So I had to open a new, just start afresh with this new account. So like I don't influence you with some stuff that I already have on my own personal TradingView account, but I'll show you what I mean. So look at this on the daily. If you go to indicators right here, click this and click MAEXP ribbon right there. It's gonna pull up all these different moving averages, right? Now what this is, basically EMA means exponential moving average. It basically just tracks the general like movement of everything, right? But it's kind of noisy, so I'm gonna take off most of them and focus on 30 because that's what I use. This is an exponential. Let me switch it to switch this to green. Red. Let me add another one. Let me add 50. Straight up moving average. The difference between moving average and exponential moving average is moving average tracks everything but doesn't put a specific like it. Exponential moving averages, basically the more recent the candle, the more important it is, but a normal moving average just doesn't do that. It just puts like a general just random. It just tracks the daily movements without putting any specific influence on anything. Yeah, man, your cloud is. It's not. I'm not interested in clouds. I feel like it's the modern day equivalent of freaking wearing like some hipster type shit where you just put on big glasses and act like you know shit. Now, the most important thing about the 30-day moving average is it tracks bull trends and bear trends, right? So I'll show you what I mean. See how this comes down here? Like right here, it's trading above this. It's kind of supporting it. Let me use something else. See how this supported this right here, and then it broke down right here. It tested it twice, and it became like a curved, resistance level. And then it broke down, right? This is how you know. This is how you know a bear trend is beginning, right? But it's important to remember that it might still break up again, and when it does, that's the beginning of a bull trend. Now, this may not be super important for trading some high leverage coins, but if you're an altcoin type of guy and you're trading, I don't know, yeah, a lot of people were buy holding, DGB when it was dying. But if they knew not to trade like this right here, this is how you know a bull trend is beginning. When it's above, see that? You see that when it broke up above here? This was the beginning of the bull trend, right? It went up, it came down, but it still struggled with this. Then it broke up again and continued that bull trend, right? And as long as this stays above the 30-day moving average, it's bullish, right? But when it trades below it, when it opens and closes below that 30-day moving average, man, you have to run like hell, because that's the beginning of a bear trend. Now, some people like to mix, certain different averages to kind of help them track this sort of movement, this bull and bear trends. So you can add a second one. You can add this is a 30-day normal moving average. You can add an exponential moving average exponential. You can now add a 30-day moving average exponential and pick a different color so like it's easier for you to see. Let me make this lines bigger. I'm going to change this to green. So this kind of, it helps them refine, it helps them, let's use log scale for this. It helps them basically refine the bull and bear trends. So if you use this strategy, right, once the 30-day normal moving average is like when the exponential moving average crosses above the normal moving average, it signals a bull trend, right? But when it crosses below it, then it signals a bear trend, a bear trend. Basically means to get the fuck out, right? And you can use this thing with most charts. Let's pick, I don't know, Ripple, because that pumped recently again. And you can see where I don't know if I could move this. You can see where it crossed right there. Bull trend, right? Traded, crossed below, right? Bear trend, but then it crossed over again, and you get another bull run. But then it crossed below here, and to exit, right? This is now a bear trend. And again, the 30-30 is not the optimum setting. You're gonna have to basically fiddle with the settings to kind of help you find a specific Okay, so what this 30 is 30 candles, right? That's what it is. So you can use, say 10 candles, and it then that was the wrong one. Yeah, but you kind of see how it. Let's see. Let's use 1010. You kind of see how it's now like too close, and it doesn't really make sense. But it's way more like accurate. It follows the candles a lot closer. So if we use, let's say we use 15 or even 20 moving average. Now the exponential is following the candles way more closely, and you can see how it acts like support right here and right here and then here, but then it breaks down, then this crosses below this, and it's dead, right? But then it runs again, but then this acts as resistance, and that's a confirmation that it's proper dead. But most people use 30 MA and 15 EMA, or they'll use 200 MA and 50 EMA. But that's more of a forex type setting, right? For the guys who trade forex and more established markets. By the way, if we just put some normal, like usual horizontal lines at the previous low here, it basically shows you where it was supposed to bounce, but it's trading below it. I wouldn't buy this because this crossed below, so that's bearish, and at the same time it's trading below this previous see, there's a phrase, support becomes resistance, right? In this case, it was resistance, it broke above it, became support. Then it came back here and became support again, bounced again, but now it's trading below it, which is not a good sign. I would stay away from Ripple, although most people are shilling it on Twitter. And then I'll try to get another support right here, and this is where I would be buying next time, because I see after the support, let me turn this off. It acted as support here. Hopefully, it's gonna act as support again, and probably bounce and and then trade within this range, and then decide if it's gonna go up or down. I haven't heard from you guys in a while. How's this going? Good. Okay, so going back to the almighty PowerPoint, let's talk about volume bars and why they are important for trading, and why I've picked it as opposed to some other thing. Now, with volume bars, you're gonna have to set them to be more like visible. Yeah, maybe that's too visible. Take out the line, it's not really useful. Okay. What this helps you do is it basically tracks when the whales enter the market, right? And one of the most important things to remember with watching volume bars is if something is trading within a range and you keep seeing like giant green bars like right here, these just giant green bars. By the way, this basically tells you how much was traded. If you look over here next to the volume thingy, it shows you how much was traded in that one day, that one green bar, and you can see how like there's a shit ton of buying going on right here, and this precedes the next run. And this is important because it shows you when the whales enter and exit a market. So, and it's also very important to remember that, like, the biggest green bar in a run is usually the top. So, if we go back to BTC USD, I'll show you what that means. Go back to stamp. So, if you look at this run and this giant green bar right here. Now, if it's in a dip like this is a dip, then you see a giant green bar. It basically means a huge whale has entered the market. Right there. And you can see it's the biggest green bar ever, right? Now, it could be one whale, it could be, well, in this case it's BTC, so it's probably a bunch of other people, like a ton of people. But it basically tells you, okay, this is not looking good, right? Or something's looking really bad. And this is important more important in alts, lower volume alts and stuff like that. So let's use something like a lot less. Let's use, I don't know. Someone suggest something that we can use to do this. Yeah, it's very important to do this directly on exchanges. But if you have Coinigy, for example, then you can do that as well. But I'm using TradingView today because that's my favorite. It's my favorite, aggregator. But if we go to the markets directly and look at something like, okay, let's use VTC because it's the coin that's pumping right now. I don't know. First things first, switch to daily. Right. You can see how, once again, the biggest green candle is usually at the top, right? You see that right there? Let me switch this to dark theme. Yep. See how the biggest green candle is usually at the top? You don't find a candle that big anywhere, right? Then you see this. That's basically telling you, okay, this is probably the local top of this run. And you see it again right there. The local top, once again, coincides with the biggest green candle. Same thing here once again. So I don't know if we go back to in July. Now here it's a red candle, but same difference. The biggest volume it runs is usually at the top, right? Because when people accumulate, they don't do it, at the top. They do it usually like right in this range when something looks super dead and it's just going sideways. That's where they buy. Around there, right? This sort of sideways here is when the whales accumulate their coins over months. The run is just to pump it up. They don't actually buy there. So same thing with this, biggest candle again is the top. If we go back and look at some other, I don't know, some other markets. Let's use Strat. Everybody loves Strat. Now, if you look at strat, you can see how this again works. Biggest candle, usually at the local top, but then you see these other candles once again, the biggest one at the local top. But in this case, if you add, oh my god, it's gone again. This is annoying. If you use 15, 30 EMA and moving average, come here. What's the shit? So if you use 15 EMA, let's make this green, and 30-day moving average, let's make this red so it's easy to see. You can see where the run began, where the bull trend began. When this left the other one like crazy, right? Then you can see how it acted as support right here, acted as support once again, acting as support right there, acting as support, and then it ran until again acting as support all the way up, until this then crossed below this at 300,000 basically. That's when you know it's over, right? Now you can probably set the averages and find what's best for you, but 1530 is probably the best starting point. Then you can see they just freaking hug each other all the way down, and you can see how it's now acting as resistance right there, right there, right there, right there, all the way down, right? But now it's looking a bit different, because if you draw some basic support and resistance lines right there, see how that's holding, and you've gotten what's called a double bottom, and now you're seeing some green candles, some green bars again, which again, this is where they accumulate, right at the bottoms, and then the pump begins. Like you see the volume candles in the pump is actually like way lower than the volume candles in the beginning. That's the difference between actually accumulating coins and just pumping to pump, right? And then death all the way down, no buying at all, nothing's happening. But now you're seeing some green candles again. And that's how you know you might be close to a bottom. Once again, you're gonna have to put this all together to decide whether or not you're gonna enter a market or not. This is probably the new range. It's probably gonna flop around over here, maybe accumulate some more, or then decide to break up or down. How's it going? Talk to me. Great. Okay, so once again, you can see by this example, it's not going to be perfect. It's not going to just touch it and then run away. But you see how it's acting as resistance. By the way, this is 50 EMA, but it's more of a 50 and 200 are more Forex type examples. In crypto, most people use 30 and below it, because in most of these charts, you're not going to find 200 days of trading, history. So there's that. But you see how here it's resistance, 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 but then it breaks it, right? Then it becomes support, support, support. That's the magic of moving averages. And then right here with volume spikes, you can see how this largest volume here, green or red, is usually the top. Then it comes down again. Then you see the micro buys, and then the next largest candle is again the top. Then you see micro buys, but you can see here how the moving average supported, then broke up again. So moving on, let's talk about the other stuff, the things that I can't easily just put in a PowerPoint and stuff. First thing to talk about is candle styles. A lot of people use different kinds of candle styles. You're gonna see people use Heikin-Ashi, right? Basically tells you when something is perpetual downtrend and when it's bullish. Heikin-Ashi is good, but one of the cons is that it doesn't really capture spikes all the time. So if you use normal candles, it's actually good in this case because it gets all the spikes, but a lot of times Heikin-Ashi is not going to get all the spikes. But my actual favorite is the line chart right there. Now the line chart is actually useful because if you have a really spiky thing, let's think of a spiky I don't know. Let's go back to BTC USD because it's easier. So if you were using like normal candles, you're not really gonna know where to draw your lines or whatever, and you're like, I don't know, is it from the candles? Is it from the spikes? Is it from the bodies? You're not sure, right? So you just switch to a line, and it gives you a better idea of where to actually draw your lines. So sometimes when I draw multiple lines, I basically draw from the line chart, and then I change it back to candles, and then I draw a separate line from the spikes, right? So you might see me have like two lines or something. That's what that is. So line chart, if something's too spiky and you're not sure what exactly it's doing, the line chart is probably your best friend, so you can understand what's going on, how to deal with it. So once again, speaking of what we just talked about, see how this top right here coincides with some of the biggest candles, volume bars. It's usually the top green or red, it doesn't matter. And you see how once again the local top here is the biggest recent volume bar. Same thing there, biggest recent volume bar is the local top, and it goes down. But then you see when it dumps and it hits your this spike down here, you see some green buys, and then boom, it goes back up again above the 30-day moving average. Just if you put these three indicators together, it shows you, really, it gives you a clear picture of what to do when to exit. And, from there you can then decide. Okay, maybe I want to be an Ichimoku type of person or whatever, and then you can just move on from there and decide. Um, what specific settings you want to use for your indicators and stuff. Now, the other stuff, order books. This is one of those very important things that most people don't really do much in crypto, but it's actually very important. If we go back to Trex, if we go back to Bittrex, I don't know, let's use ETH. Let's use Ethereum because it works best with this on Bittrex. Now, if you switch to daily, that doesn't really matter. Switch to this order book and switch to 100%. You can basically see how the whales are moving. You can see how there's a giant sell wall right here. Switch to display rows. Switch to 50. You can see how there's a giant. Well, I mean, it might not be too big for ETH, but this 15 BTC sell wall right there, and you can see how on the buy side there is no like order of such size all the way down to 4-5 right there, right? But right here at the very next, like at the very trading range, there's a big sell wall, and you can see it reflected there. This is what we call a herd wall. Now, usually in crypto, it's like the opposite of what the market maker wants to actually do. If you see a big sell wall, it's usually a buy signal. Usually, sometimes someone just wants to dump on you, and they're gonna put up a giant sell wall. That's one thing, right? But most times, a giant sell wall is a buy signal. A giant buy wall is a sell signal. And this is just something you're going to notice after a while of trading. Let's pick a smaller cap so you can see. Let's use CVC or something. Freaking Vinny's shitcoin. No, this doesn't really say anything. Let's find something with a really tiny order book. Parkbite. Now, if you have Coiniji, you can actually see this better in detail. I don't think it's best on Trex, but you can see it better in detail if you had like a. Okay, this is still like super big. APX. Good. Now, see this? What this tells you here, look at this. It takes half a BTC to get to 89, basically 90,000, right? It takes half a BTC. but it takes about the same price to get to 70,000. So what the order book is telling you, and the market maker, is that it's easier to pump this to, see, it's easier to pump this to 90,000 than it is to dump it to 70,000, right? And if you look at I don't know, let's last. So the entire again, I think Trex doesn't show you the entire order book all the way up to whatever, but you can see the entire order book all the way to 100,000 satoshis is 4 BTC, right? But the entire order book down to 50,000 is about the same price. So it's more likely to go this way to 100,000 than it is to dump to 57,000 satoshis. Now that's not something you should bet your entire account on, but it kind of helps you see where the tide is going, right? I remember back when all the fair pumps and all the pump group guys were around. One of the things, the reason they picked the same 5-6 coins every single time is because it's easier for them to pump it, right? They're not going to use, I don't know, someone tell me a really low cap coin on Trex so I can prove this point. What's the lowest cap on Trex? Everything here is like super high cap. EFL probably. That's probably good. If you look at the EFL order book all the way to 100%, this still doesn't show you what I mean, but usually when you look at order books like this, you can see like how easy it is to pump something versus how easy it is to dump it. Again, I can't find a proper example because everything on Trex is super high cap, but you can probably tell where something is gonna dump to and where it's gonna pump to by just looking at the order books, looking at how high it can go. Like for example, price right now is 1,006. It takes 3 BTCs to pump it to 2-1, right? But at the same time, it takes the same amount of BTCs to basically dump it to 0. Like the entire order book to 0 is 3 BTCs. So if you're looking to buy or sell something, it's probably easy to just read the order books like this. Now, this is a skill that's gonna take a while for you to learn and stuff like that. But this stream is getting too long already, and yeah, possibilities. This is what I was talking about with the Bull Kowalski thing. I'm gonna try and get you guys probability Excel sheet. But in Kowalski's site, you can just go there, look at a specific pattern, find out what the probability of it breaking up or down looks like. Again, so for example, double tops, right? In a bear market, the failure is 53%, but in a bull market, the failure is 63%. It's about like half and half. but it's ranked here as being most reliable, right? So like you should get an idea that in TA it's not like everything isn't 100%, right? Things are gonna be 50%, 60%, 70%, but like if a pattern, if you drop a pattern, it's very likely gonna fail, and if it does, you shouldn't be like surprised, right? You shouldn't put in all your hopes in this one pattern holding and never failing. And I think the most important thing to remember is this phrase: Google is your best friend. When you find someone post something, like I remember last week, Peter Brandt said something about a pattern. Peter Brandt put up a little pattern here. He called it a hikake. I'd never heard of it. It's probably one of them Japanese ones. Like I said, a rare pattern. You've never heard of it. You don't know what it's about. You simply go Google it up. And then you're like, oh, okay, this is actually interesting. Like, what is it? You look it up. You find out what it is. You read about it, and then you realize, okay, this is now part of my arsenal. Right? Next time, the fuck is this? Next time when I see this, I'm gonna recognize it, right? Because you're not gonna find a book that has all these patterns like forever. But you should always just Google things and read about them. I'm pretty sure when I looked up the Bukowski site earlier, if you just went to chart patterns. And looked it up. Can't even find the damn thing. I saw it earlier when I was looking. Yeah, the site talks about it. Peter Brandt is a little weird the way he draws it, but you can just read it, find out what the bullish continuation percent is, and what the how likely it is to break up or break down. Bull market, uptrend, falling trend. You could just read all of that and learn specific chart patterns and specific possibilities of it breaking up or down. That will teach you more than reading any specific book or watching some random video and hoping that you see that pattern at some point. It's better to just follow people on Twitter, which is the point, is to follow specific people who give you information that's useful, than just Googling that up and reading about it. So with that, I think we've hit like an hour or two or something talking about this, so we'll end there and do another class, hopefully not in months or like a bunch of weeks, but we'll do another one pretty soon and see how it's going. Now, this is the part where we do the Q&A, so you can ask me something and I can answer you directly in the. And I can answer. Yeah, eBoost. Okay, let's look at that. Let's look at eBoost on Trex. But I remember eBoost pumped like a lot, so the whole thing's probably fucked up now. If you don't switch to daily, you're not gonna know what the recent moves are. But you can see where the whales or whatever bought in. You can see they got in here, and then the recent biggest candle was the local top. And then they bought in again. Then the recent biggest candle was the top, right? Then it just went down from there. But if you look at the order book, 100%, you can see how easy it is to pump this to 3,000 satoshis. It's 2 BTC. It's nothing. Versus how hard it is to do the opposite, right? It's easier to pump it to 3K than it is to dump it to 2.5. See, and the price right now is 2.6. And this kind of helps you. Now, if you have Coinigy, it has much better record of the whole thing. So Trex doesn't show you, Trex doesn't properly show you everything on all these coins. But it basically, you can see, how hard, like it's 11. It'll take a pumper like 11 BTC to pump this to 3K, but 8 BTC to dump it to 0, right? If you go to last, you can see how much it costs to dump it all the way down to this, and it's basically nothing. 8 BTCs, but at the same time, 8 BTC would take you to 3K satoshis. This helps you know how the market's looking, how the buy support is looking, how the sell resistance is looking, and all that. So, questions. Ultra low cap. Yeah, I don't even think eBoost still. Cryptopia. I don't even think eBoost still counts as an ultra low cap these days, because everything is pumped to hell. So if we go to if we go to Utopia and look at some proper like shitcoins, let's look at I don't know, whatever this is. KRB or whatever. If you look at switch to daily. Sorry, you have to switch to all. That's probably better. And you can see on this shitty chart, you can see where they bought all their coins, then the pump. But you don't see a lot of exits because it's probably not, the pump's probably not over. And you can probably like read the order books and see like how much the sell resistance is. 65 BTC to 95,000 satoshis, right? But basically 1 BTC to 0. Yikes. So this is where you want to like buy dips, and if you wanted to put up a dip buy order, you're gonna want to put it in front of a big buy wall. So you're gonna want to put it in front of some guy who's probably someone like Needlecoin who's trying to buy some shitcoin somewhere, and they've put a bunch of buy walls all the way down. You're gonna want to put your order 1 or 2 satoshis in front of it. So yeah, same thing. But I don't really use Topia because I don't freaking play these ultra low caps. I'm not that good at it. But yeah, you can see what I mean. You can see right there where the buy walls are. This is 2BT. Well, it's not really a buy wall, but for this market, it probably is a buy wall. And you can see where the buy walls are all the way down, and you can see where the sell resistance is all the way up, right? And you can calculate, okay, this takes 3 BTC to get here, and 4 BTC and 5 BTC and all that. So if anyone wants to ask a question, probably best to ask now before I bail. Any questions? Okay, we're gonna end. Thanks for checking it out and asking stuff. Hopefully we'll do another one soon. Not in 2 or 3 weeks, but soon. Yeah, thanks, Michael. Great. All right. Yeah. Thank you. Thanks for having patience while I, put this off for weeks. Yeah. You can still contact me on Twitter if you need stuff. I can still help you without doing a whole class about it. Yeah. Till next time. Peace out.